Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to BCI Podcast number 4, titled Managing News-Driven Gap Downs, a real-life example with Stamp.com. Now, in the BCI methodology of selling options, whether it's covered call writing or selling cash-secured puts, we want to avoid all risky events. And that's the reason why we have the rule regarding never to sell an option if there's an upcoming earnings report. But rarely, but from time to time, some bad news will come out unexpectedly. We have to be prepared for this and know how to react. And it should be done in a non-emotional way. In this particular presentation, we're going to discuss a trade, or a couple of trades made by Earl, a BCI member, regarding Stamp.com. So on July 25th, Earl contacted me and gave me a bit of the history of this trade. On June 18th, he purchased Stamp.com at $283.94 and wrote a covered call that generated $480 per contract. Now, just a couple of days later, lo and behold, the price of the stock gapped down over $30. And that was related to an announcement that President Trump made suggesting possible restructuring of the U.S. Post Office. Now, on the 25th is when Earl wrote to me, and he was just concerned about how to manage a situation like this. If he sold the stock after closing the short call, he would lose a lot of money. So how do you handle this? Well, most importantly, it has to be handled in a non-emotional way. So the first step is to check the reason why the price of the stock gapped down. It wasn't from an earnings report because we'd never put ourselves in that position of writing a covered call with an upcoming earnings report. So it had to be something else. Well, the news resource that I use most frequently is finviz.com. It's a free site. And when you put the ticker in, symbol in, it will give you all the news that relates to that particular security for the last several weeks or even months. In this particular case, we got the information about the market overreaction, actually, to President Trump's statement regarding a possible restructuring of the post office. So, overall, if I looked at it at that point in time, I would kind of feel that the reason for the gap down was not an egregious or a long-lasting one. But of course, that's subject to interpretation. So let's have a look now at the price action of this stock in 4 different time frames, and we've kind of color-coded the time frames we're going to be alluding to. And the yellow area over here, the first one, that's when the trade was entered. And you can see we have a bullish chart pattern, uptrending stock. Everything looked really good. And so I think Earl made a very good decision using this security for his covered call writing portfolio. But then lo and behold, very shortly after entering the trade, we see this purple field over here, and that's where the Trump announcement came in. You could see the price of the stock seriously gapped down. So that's when, most of us would have a tendency to panic unless we're prepared, and those of us using the BCI methodology must always be prepared, even for scenarios like this. So what happened? Well, just as quickly as it went down, the brown field shows how quickly it went back up again. And the market evidently took a deep breath and realized that it was an overreaction. It's still a great company, making lots of money, increasing revenues and earnings per share. And, why should we treat and hammer a stock like that over an announcement that may not even impact the company in a big way? We just don't know. Now, the greenish field all the way to the end over here, right over here, shows, again, a decline in August now. This is after Earl contacted me. It went down and then back up again, and this was also around some earnings time. So we're going to focus mainly in on the yellow, purple, and brown fields that we showed you in this particular diagram over here. So you could see that at the time of the contract expiration, the price of the stock had come just about all the way up. So the story kind of has a happy ending for Earl. But what could he have done? Well, first thing I want to point out to you is that when the price of the stock gapped down over here, it then almost immediately gapped back up again. Now, for those of us that are familiar with the exit strategies and the BCI methodology, you see that classic V-shaped pattern. That's known as hitting a double. And that's when we buy back the short call and resell it, resell the same call if the gap down occurs early in the contract, the first half of the contract, and there's still time value left. So that's another reason when the price of the stock goes down dramatically, we just automatically buy back the option that we sold using the 20%, 10% guidelines. In this case, that would definitely apply. So there was an opportunity to resell the option after buying it back in a matter of just a couple of days. So story, as I said, does have a happy ending. So let's just kind of summarize how we manage these gap downs. First, we must determine what caused the gap down. As I said, finviz.com is a very good resource. Reuters, Bloomberg.com, CNBC, there are a lot of very good resources. My go-to is finviz.com. Now, we buy to close the original short call if we're not near expiration. If expiration is coming up, well, then we just let the option expire and make a decision the following Monday or Tuesday what we're going to do with this stock. And of course, a lot of that would be based on the news that we determine for the cause of the gap down, whether we want to keep that security in our portfolio for the next contract. Now, we could sell another option if there's time remaining until contract expiration. So for a monthly contract, that's usually the first 2 weeks of a 4-week contract or the first 3 weeks of a 5-week contract. It's one of the reasons why I prefer monthlies over weeklies. With weeklies, you have very little time to maneuver. And in this particular case, Earl was using a weekly. But my sweet spot are monthlies, and this is one of the reasons why. It gives me an opportunity here to generate 2 income streams with the same stock, with the same cash investment, by buying back the short call and reselling it when the price went up. If the price didn't go up, we could roll down to a lower strike price or just sell the stock if we had it with the stock and if we felt that the reason for the gap down was in fact very serious. So our trading reaction must be non-emotional. We must be prepared in advance for every and all possibilities, including these news-driven gap downs. And then that, in the long run, will make us some money and allow us to generate the highest possible option selling returns. Now, when the price does gap down and we're buying back the short call or reselling another option or rolling down, the price that we paid for the stock originally should not impact our decisions. It should be based on what is happening today, right now, at this second. And the price of the stock is a certain price, and based on that, what management maneuvers will we make at this point in time. So it's very important, not emotional, and not factor in something that happened a long time ago, but what's happening right now today. So there you have it, ladies and gentlemen. Managing news-driven gap downs. It doesn't happen often, but if you're going to invest over the long haul for years and decades, it's going to happen rarely, but it will come up, and we have to be prepared and know how to react. So I want to thank you all for viewing this podcast. I hope you enjoyed it. And of course, most importantly, I hope you make some money from it. As always, this is Ellman, the Blue Collar Investor. Take care, everybody.